Hello guys, good evening. I hope you are doing great. Well, in this particular video, I'm going to demonstrate a solution for the problem which appeared in the year December 2016, Jan 2017. It's a second semester MBA FM question paper from VTU. And the question number which I'm going to address is question number 5 as per the section C. And as per my workbook, it is the question number 13 in the investment decisions. Well, let us brief this question and then we'll see how to go ahead with this one. The problem starts with the given data here. Let us review this. The directors of ABC Limited are contemplating the purchase of a machine. Two alternative machines, old machine and a new machine, are under consideration. Ignoring the interest but considering the tax at 50% of net earnings, calculate annual cash inflow from both the alternatives. In simple words, the target here for us is cash flow after tax, which is certainly a net cash flow after the taxation and adding back the depreciation, which we all are aware of. In the table, you can see here there are two columns which are talking about the old machine and the new machine with the particulars which are given here. Purchase price, estimated life of machine, machine running hours per annum, units per hour, wages per running hour, power per annum, consumable stores per annum, all other charges per annum, material cost per unit, selling price per unit. And they say you may assume that the above information regarding sales and cost of sales will hold well through the economic life of each of the machines. Therefore, by looking at the given data here, this is something special which we came across in terms of the investment decision numericals. However, this is just a application oriented. It's just an application oriented. And let us now proceed with the solution. We know that what is that we are supposed to do. They say that calculate annual cash inflow from both the alternatives, one is the old machine and the another one is the new machine. By considering both the cash flows, you will have to figure out the CFAT. Now let us write here together determination of CFAT. Determination of CFAT. By now we know that we are supposed to get the CFAT for both old machine as well as a new machine. So what I'll do now, I'll be just having a table here for a simple representation, right? I'll be writing particulars as the first column, and then I'll be taking the old machine and new machine in the column here. You can practice the same watching this video. I'm not that good in terms of getting the rows straight, but anyway, I'll try my level best and then we shall proceed with this. Okay, so our statement format is ready here, and we will be proceeding with determination of the cash flow after tax. Well, when we talk about the business, when we talk about the revenues, when we talk about the cash inflow, there comes a point where a business will certainly get the cash inflow when they make sales, right? The revenue, the very first point which the firm or an organization receives is called as the sales revenue. And now here, when you look at the table and the particulars, you may not see the sales data. Yes, of course, you will not be seeing a sales data. However, if you look into each of these particulars, you'll be seeing somewhere here which is talking about the selling price per unit, rupees 1.25 for old machine and rupees 1.25 for new machine. But it is not the overall sales. Now, how do I get that sales is what a big question for us now. We need to get the sales for both old machine as well as new machine. Let me use this space as the working note area so that you can also make a note and then you can understand. We are talking about the sales, right? Let us calculate the sales for old machine first, and then I shall take you to the new machine sales calculation. You may think now, why is that we are talking about the old machine and the new machine? Remember that we are ultimately targeting both the alternatives in the question, which is said for the old machine and a new machine. There are two alternatives, and we get the sales from the business, that is ABC Limited. For the ABC Limited, whatever the money they receive after the sales, that is called as the revenue. That's the inflow. But now, since the question is focusing on the machine, I just want to figure out how many units were sold at what price using a old machine so that I get the sales data. I repeat, I just want to figure out the sales amount for the old machine and the new machine by knowing how many units are sold at what price. Now, it is clearly given here selling price per unit old machine is 1.25 and new machine is 1.25. Selling price is clear, but the units, that we are not aware of by looking at this. Units, you will not be seeing a word here called as the units. However, there is something called as purchase price, estimated life of machine, machine running hours per annum, units per hour. And now probably you will be getting a hint here that when we're talking about the machine, how do we get the units? Right. Now, if you just see here, using the old machine, units per hour is 24, and units per hour using your new machine, it is 36. Therefore, now I'll just write here for the old machine, 1 hour, for 1 hour, how many units you are getting for 1 hour, units per hour for the old machine, that is 24 units. And now if you look into the rest of the particulars, let's see whether we get any logic here to figure out the old machine units and the new machine units. But we got to know that using a old machine for 1 hour, we are getting 24 units. But we don't know how many total hours used in a particular given time frame. Now, if you look at the wages per running hour, that's related to the wages, power per annum, consumable stores per annum, all other charges per annum, material cost unit, and then selling price per unit 1.25. Now, just by looking at these data, you will be thinking that, okay, these data are not related to the machine, but yes, just about the units per hour, if you see machine running hours per annum, the total number of hours happen to be 2000 hours. Now, for 1 hour, if it is 24 units, then for 2000 hours, how many units it is? Certainly, by now you have understood how to calculate. It's a cross multiplication, and you can consider this as a x here. For x is equal to, you can now say 24 units multiplied by 2000 hours. It's a cross multiplication, right? Cross multiplication and divided by 1. Anyway, it's okay. Now, for the old machine, you can say 24 into 2000 hours. 24 into 2 is 48. Therefore, you can say 48,000 units. Fantastic. This is how we get the units for the old machine. Now, I'll just write here for the sales old machine. I'll be writing here old machine, that is 48,000 units, and this units should be multiplied with the selling price, and that selling price happens to be 1.25. And now if you multiply with this 1.25 and 48,000, you will be getting the 60,000 as the sales for old machine. Now in the same way, you will have to calculate for the new machine the same way. Now, when I say the new machine, units per hour is 36. So I'll be writing here 1 hour is equal to 36 units. In the similar way, for 2000 hours, that is 2000 per annum, right? Yes, 2000 hours is equal to how much? Therefore, again, cross multiplication, I'll be writing here x is equal to 2000 into 36 divided by 1. And this is equal to 36 into 2000 is equal to 72,000 units. So the working note holds good here. Now for the new machine, I'll be writing here in the table, new machine, we got 72,000 units, and that is multiplied with the selling price of 1.25 for the new machine, 1.25. And if you multiply this, you'll be getting 90,000. So you got the data, required data, and then you calculated for the sales. Now, before I go for the finding out the CFAT, we know that when we have the first revenue, the first source which the firm is getting, that is 60,000 and 90,000 as a sales, now we need to deduct some expenses, less expenses. Now, what kind of expenses we generally come across here in this particular problem? We have something called related to the wages, power, consumable stores, all other charges, material cost. Now, these are all called as the expenses. Now, we need to deduct all these expenses so that we can get profits before depreciation and tax. Therefore, now let us proceed. Now, when we talk about the wages for the old machine, what is that wages is talking about? Wages says per annum, wages per running hour is rupees 3. Is rupees 3. Therefore, how many hours are actually in total? If you look at here, it is 2000 hours. I repeat again, wages per running hour is rupees 3, but there are machine running hours per annum as 2000. So I'll be writing here wages for the old machine. I'll just mention here old machine 3 into 2000 hours. This is for the old, and for the new, how much it will be? For the new, if you see, it is 5.25 wages per running hour, 5.25, and this is multiplied with again 2000 hours. I'll be mentioning that 2000 hours here. Now 3 is multiplied with 2000, and then you get 6000 as the old machine wages. And when you multiply 5.25 with 2000, you will be getting 10,500 for the new machine. In the same way, now let's proceed with the power per annum. That is direct. No need to do any sorts of calculation. Power, that is rupees 2000 and 4,500. For the old machine, it is 2000, and for the new machine, it is 4,500. Perfect. We are done with the power. And the next is consumable stores per annum. Per annum. Therefore, again, no calculation. Straight away, you can take consumable store. Consumable stores. 6,000 for old machine. Let's take that 6,000 for old machine and 7,500 for new machine. Great. So we have taken that. And then now if you see, they have something called as material cost. But before that, we have a consumable stores per annum. That is done. All other charges, I'll write here other charges. Other charges. And for the other charges, again, they are saying that per annum, so no calculation. So you can take straight away 8,000 and 9,000 other charges. So I'll be writing here 8,000 and 9,000 other charges. And the last one is material cost per unit. Be careful. Material cost, they are saying that per unit, material cost per unit. Therefore, for old, how many units we had? It is 48,000 units, and that is multiplied with 0.5 for the old machine. And for the new machine, we had 72,000 units, and that is multiplied again with the 0.5. Now, when you do the multiplication, you will be getting 24,000 for old machine and 36,000 for new machine. How is that we get this 36,000? 72,000 multiplied with 0.5. And from the question, if you see here, there are no other particulars which are talking about the expenses. So I'll be closing here, and I'll be considering all these expenses to know what will be the total of it. And now if I do the total, I'll just give a kind of pause for you guys to do a quick calculation for all these things to know how much it is in terms of the total, especially the less expense. So that is I am interested with. Now, if you add 6,000, 2,000, 6,000, 8,000, and 24,000, you will be getting all together of this as 46,000. All together of this as 46,000. So I'll be writing here 46,000 all together. And now if you total up all these expenses particulars, whatever you have written, 10,500 plus 4,500 plus 7,500 plus 9,000 plus 36,000, you will be getting 67,500, the total expenses for the new machine. Therefore now 60,000 minus 46,000 happens to be 14,000. And 90,000 minus 67,500 happens to be 22,500. When you are solving this problem with me while watching this video, I would recommend you to put a pause every now and then do the same kind of calculation so that you will be understanding very easily. Now, what is this 14,000 and 22,500? It is profits before depreciation and tax. Now, the moment when we talk about the profits or earnings before depreciation and tax, we know that we need to deduct the depreciation for the old machine as well as new machine and then provide the taxation. Maybe by now you might be aware of how to calculate depreciation. I'll be showing here working note the depreciation for both the alternatives. Depreciation is equal to, we know that, cost of the asset minus scrap value divided by life of the asset. Therefore, now if I want to calculate the old machine depreciation from the question, I will have to check out what is the cost for this particular machine. For the old machine it is 40,000, for the new machine it is 60,000. And in the question, they say ignoring interest, considering tax at 50% net earnings. There is no information related to the salvage value or a scrap value here. So let us not worry about it, but we will consider 40,000 and 60,000 as a cost for the old as well as the new machine. So here for the old machine, I'll be writing 40,000 minus 0, scrap value is 0. And when I look at the life of the project here, life of the machine, now you can see in the question they have mentioned that 10 years as the estimated life for both the machines. So I'll be writing that 10 and then 40,000 minus 0 divided by 10 happens to be 4,000 for the old machine. Fantastic. And for the new machine, I'll just again bring it here to the question. It says 60,000 as a purchase price or a cost. I'll be writing that 60,000 minus 0 scrap value divided by life of the asset is 10 years. And then I get 6,000 as the new machine depreciation. Therefore, now old machine 4,000, new machine 6,000. That is what now we will be highlighting that here in the table. 4,000 for the old machine and 6,000 for the new machine. Now let us get the totals here. We are getting 10,000 for the old machine and we are getting around 16,500 for the new machine. What is this? This is nothing but profit before tax. By now you know that you will have to go for less tax at the rate 50%. It is given in the question here. They say 50%. It's a pretty straight, simple calculation. On 10,000, 50% means 5,000. And then here it is 16,500. On that 50% is 8,250. And the same numbers you will be getting here as the what? The profit after tax, that is 5,000 and then 8,250. And now this is called as profit after tax. But our target is to go with CF80. So what I'll do now, I'll say add depreciation. We already got to know what is the depreciation. The depreciation is 4,000. So you will have to add that 4,000 and then 6,000 for the new machine. If you total up these things, you will be getting the cash flow after tax. And that cash flow after tax happens to be 9,000 for the old machine and 14,250 for the new machine. What is this? This is a CFAT, cash flow after tax. 9,000 and 14,250 for the new machine. Now, from this question, if you see here, we have calculated the annual cash inflow from both the alternatives using the given information. Now, they say that you may assume that the above information regarding sales and cost of sales will hold well through the economic life of each of these machines. Since this kind of case is appearing in the investment decisions, using the CFAT, whatever we have here, we understand that, okay, this is nothing but the inflow which we are getting from the new machine as well as the old machine. Now, if I want to apply the investment decision technique, since there is no time value of money involved here, certainly I can go and calculate the payback period. Let me just take it here. I'll just show you how is that we get the payback period for both the machines to take the decisions. Yeah, you may note this for the old machine. We say the initial investment over CFAT, cash flow after tax. For the old machine, we know that the initial investment happens to be 40,000 and the cash flow after tax, which we got from the calculation here, is 9,000. Then I'll be writing that 9,000 here, 40,000 by 9,000. And now if you calculate here, you will be getting 4.44 years. In the same way, if I just check out for the new machine, we know that the initial investment is 60,000 for the new machine divided by, if you look at the cash flow after tax, it is 14,250. So you can take that 14,250 as the cash flow after tax. And then you will be getting 4.21 years. Now, if you look at the solution here, we just went with knowing what is the CFAT, because when we talk about the investment decisions, we need cash flow after tax. We need inflows, in simple words. And that is what we derived, and we applied a very simple and a basic rule for the payback period to check with what is the cash flow we are getting and what is the investment we are making. Now, the cash flow after tax, when we just apply this, we get that 4.44 years for the old machine, and for the new machine, 4.21 years. There is a sensible decision making from the manager here that you may opt for replacing a machine with a old machine with the new machine, because that helps you slightly. It helps you in terms of recovering your money or getting back the money quickly when you compare with the old and a new machine. So that's all with this particular question, what I wanted to communicate to you. If you have any questions, you're free to write an email to me, or you can just text me over the WhatsApp, and then we can take it up to the next level. Thank you so much for watching this video. Thank you.